every quarter, super investors must disclose their buys and sells from the last 3 months, and today we want to take a look at Warren Buffett's portfolio as we have identified a brand new buy, and that is Constellation Brands. In fact, as we can see here, he has bought more than $1 billion worth of shares in the company, and as we can note, it is the only new position in his portfolio. We do notice adds to Occidental Petroleum, VeriSign, as well as a few others, and we have covered this in just yesterday's episode, so if you want a bit more information, do check that out. But today we want to understand, is Constellation Brands a company that Wall Street see as a lot of upside over the next year, one we should add ourselves? Now, for those that don't know, they are a leading beverage alcohol company. They produce and market beer, wines and spirits, and they own popular brands like Corona, Modelo and Robert Mondavi, and they primarily operate in the US whilst having some investments in the cannabis industry. Now, they have suffered over the last year, down around 33%, and if you zoom out to over the last 10 years, they're up only 41%. That is a massive underperformance of the S&P, but what's very interesting to note is upon the disclosure of Warren Buffett's new buys and sells, we can see Constellation Brands was up after hours around 8%. Will be interesting to see on Monday morning where this company heads, but right now it is pretty much sitting right there at its 52-week low. We only get a buy from Wall Street, although as we will discuss later in our own valuation, they see a ton of upside over the next year. We get a hold from Seeking Alpha and a fairly rare sell from Quant. In terms of yield, they do pay a dividend sitting around 2.5%, and just their latest earnings, it wasn't the greatest. In fact, we can see here the company stock was plunging after their earnings miss. In fact, they were on track for their largest single day percentage drop since 2013, and that is not really a great look. But interestingly, Warren Buffett has added to his portfolio, although we do have to make clear, given this is the last quarter, he could have bought any time between October and December last year. In terms of how bad the earnings were, well, they reported $2.46 billion. The market wanted to see a little bit higher at 2.53, but we also noticed their EPS coming in under, so a double miss. 325 reported, the analysts wanted to see 331. The bad news didn't stop there, as the company also slashed the lower end of its full year outlook, and they say this is to reflect the reduced growth expectations for both their top line sales as well as their operating income. And they point this cut to the subdued spend and value-seeking behaviors that have emerged among the legal drinking age consumers in Q2. So we don't know how long this issue is going to continue, but as we said, it was the worst single day drop for Constellation Brands since 2013. If we expand to over the last 4 quarters, it is a fair rare miss from this company. As we can see, they have outperformed on 3 of them, giving them a 75% track record, and they still anticipate growth over the next 4 quarters, although sitting somewhere in the low to mid-single digit. In terms of the next full accounting period, February 2026, based on the EPS expectation, this company currently trades at a forward P around 11.2, and whilst they do get a C- on the valuation, what we can notice, it does trade at a significant discount to the overall sector. In fact, you're getting a 26% discount to be specific, but we also notice trading at quite a discount to their own 5-year average of around 42%. No matter which valuation metric you look at, you probably do get to a similar conclusion. This company is trading at both a discount to the sector, but also to their own historical averages. Doesn't necessarily mean we should be adding, but definitely gives us more of a reason to dive a bit deeper. And overall, in terms of a growth grade, they get a B. Year-on-year revenue around 4%, moving forwards over the next year around the same 4%, a lot better than the low single digit of the sector median around 1 to 2%, but not far off their own historical average around 4%, which does let us know this company typically grows their revenue in line with inflation, and we can in fact notice here in terms of earnings per share over the next 3 to 5 years, its anticipated growth compounded annually at 9%, a little bit higher than the sector comparative at 7.6%, and also a little bit higher than their own average of 8.7. In terms of profitability, we do see a nice A- score. Gross margin 52%, a lot higher than the sector at 36%, pretty much in line with their 5-year average, and their bottom line at 7%, a lot better than the sector comparative, however lower than the 5-year at 9.3%. Cash from operations looking very healthy. They generate around 3 billion, a lot higher than the sector at 792 million and a little bit higher than their comparative of 2.76. Now we want to have a look at the underlying metrics of this company. Dividend safety firstly does look to be good with a 70 score. We notice a double severe undervaluation, which we will get to, but something we quite like is the fact they did increase the dividend at 13% just last April, which means over the next few months we are due for another dividend increase. It was reaffirmed that the dividend was safe on January 24, which means a dividend cut for this company is unlikely. And if we look at some key metrics from the last recession 07-09, they weren't paying a dividend back then, so no comparative data. They had below average growth in terms of sales at negative 28%, S&P negative 12, and they didn't have a far off return negative 50, S&P itself negative 55. As we said, nice increase just last April, but over the last 5 years, on average, it has sat at 4, which, as we mentioned, is pretty much the inflationary rate. They've also been increasing the dividend for the last 3 years, whilst paying a dividend for the last 8 without a reduction. So let's get into the first valuation model based on the 5-year average of the PE. And first things first, bear in mind, we're not looking at this model in isolation. We will run it through our own process towards the end of the episode, but the blue tunnel is the expected fair price of the company, right now significantly lower than even the bottom end, massive disparity, which does give us straight away a severe undervaluation signal. We then take a look at dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year. 2.48, significantly higher than 1.43. That is severe undervaluation, but so is the forward P sitting below 12 with their own average over the last 5-year period at 20. Again, pretty much severe undervaluations right across the board. And as we highlighted at the beginning of the episode, this company does trade at a massive discount to the overall consumer staples sector PE. If we then get to the free cash flow payout, as always, we do draw your attention to that over the earnings, which is susceptible to manipulation by management through accounting. Below 70%, consistently well below that in fact, 42% on a trailing 12-month, 35% anticipated over the next year, which does mean the dividend overall does look to be good in terms of both safety as well as growth expectations moving forward. And free cash flow, we want to see consistent growth over the longer term. Not too bad. In fact, it has quadrupled from 2015 to 2024 and expected to continue over the next 12 months to $11.60 per share. And sales growth, remember a minimum of 3 to 4% just to keep up in line with inflation, ideally in the 3 to 7% range, which is pretty much what we do get on a continual basis. 5% in 2024 as well has been noted, and for those that want to see it on a numerical format, pretty much around 50 to 60% growth from 2015 to 2024. In terms of shares outstanding, always something we highlight. We want to identify if the company returns excess cash to investor pockets through their share buybacks. A little bit inconsistent, but they pretty much bought back around 10% of shares into the latest quarter that sits at 183, which is always a nice added bonus, especially for companies like this one that has offered in the more recent period double-digit dividend increases. ROIC, one of our favorite metrics, 10% or more or 12 for the industry specific. Give us faith, management are able to effectively allocate their capital. And what we've noticed is from 2019, the lows of 10%, it's actually been increasing year on year, now sitting at 17, which is a good sign. Potential investors as well as current will love to see that. But one thing we also get is efficiencies in this company. As always, we want a minimum of 16%, but we actually notice it increased from 25% to 34% on a trailing 12-month. And actually, this is a very good sign. Not something we see that typical. Is what we call an identifier of a high-quality company. Revenue increases, but also margin increases, something that Constellation Brands can tick off. And free cash flow consistently above the minimum 7%, 17% on a trailing 12-month. So a lot of positives with this company, and one that actually, as we will come to show you, does look to be trading at a very attractive valuation. Net debt to EBITDA below 4 is what we want to see. This metric, remember, correlates to both dividend safety, balance sheet strength, and the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. From the highs of 2019, it has been decreasing, now at 2.88 on a trailing 12-month. Over the next 12 months, anticipated to go even lower to 2.75. So as we will come to show you, overall the balance sheet does look to be healthy and the dividend at the moment does look to be safe. Then we want to see what are the institutions doing. 77% ownership. They've been selling around 4.2 billion over the last 12 months, but actually been buying a little bit more during the same time frame. But we do have to highlight they did sell a little bit more in the most recent quarter. However, overall in 2024, institutions have been more bullish than bearish on Constellation brand. We then want to see a similar analysis for insiders where ownership sits at 12%. We get around 186,000 worth of buying over the last year. We also get some selling at around 63 million. And if we take a look, the most recent movement was actually a buy. For a sell, you would have to go to quarter four, and we note the 46 million, quite a bulk in fact. But for full transparency, we can in fact see the most recent buy was on the 17th of January, so just a few weeks ago. The director in fact buying 1,000 shares, and for the most recent sell, 660, you would have to go back to the 20th of November, and for the larger bulk, sitting around the 14th by both the EVP as well as the CEO. Now for the sales, we would say two things. Firstly, pretty outdated in terms of the analysis for us anyway to include in our own investment thesis. And the second thing is we wouldn't particularly call insider selling a bearish signal. They sell for many reasons, personal and financial. Now, how does this company compare against others in the industry for distillers and vintners? We have Pernod Ricard, Brown-Forman, as well as many famous other companies. Now, total return, including dividends reinvested over the last year, not only are they very poor in terms of 32%, but we would say this is a very terrible industry to have your money invested over the last year. Every single one. This is a first for me on this channel where we actually get to see all of the competitors return negative. If we expand to over the last 5 years, we actually get a very, very similar scenario. In fact, only one company that has been positive, and that is barely even 1%. If we extend to over the last 10 years, again, only a few that actually have returned positive. Constellation Brands, one of those at 61%. We can see Pernod Ricard negative, Brown-Forman negative, and just one or two that actually barely have turned positive. Now, bear in mind, past performance is not an indicator of the future, but always interesting to see how they've performed both in isolation as well as others, including comparisons against their peers. And then we just want to highlight the underperformance against the S&P. Over the last year, S&P 22%, STS negative 32%. Over the last 5 years, 81% positive for the S&P, still negative for Constellation, negative 14%, and over the last 10 years, massive outperformance. So when you are thinking about this company, and if you do want to execute on it, you have to have faith that over the longer term, or whatever your investment horizon is, this company can outperform the S&P, something it hasn't done at least over the last 10 years. Now, we highlighted this company in terms of the income statement. We did talk about the growth sitting around 50% over the last 10 years, but we really want to highlight what does the bottom line net income tell us? Does it follow a very similar story? And in fact, it's actually been very rocky. Some years actually they've reported a net loss, and that is why it's always important to also take a look at the income statement, the balance sheet, and perhaps even the cash flow. They reported 840 million in 2015, latest annual accounts 1.7 billion, but as we can see here in terms of the brackets, we're talking 1, 2 and 3 of the last 10 years where they have reported a loss. Definitely something to take into consideration. Now we take a look at the balance sheet, a quick health check, total cash versus total debt, where the cash itself are very inconsistent from 113 million in 2015, now sitting at 74 million. As always though, one number here in isolation on the balance sheet doesn't give anything away, so we compare it numerically and directionally to their total debt, which has increased in fact, as we can note, over the last 10 years, going from 7.3 billion in 2015 to the latest quarterly earnings at 12.19. Always something we need to take into consideration. As we saw, net debt to EBITDA earlier is reducing and the dividend does look to be safe, but something we would say to keep an eye on quarter as well as when the annual reports are released. Finally then, we just want to highlight the cash flow, the cash in fact this company generates from operations, and it's good to see it has been increasing over the period, going from around 1 billion 10 years ago to pretty much tripling on a trailing 12 month to just under 3 billion. Now, before we jump into our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone on in the market over the last few days. So click below, you can sign up, read straight away. where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab another spreadsheet of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. We did just release this last week, so click below, sign up, and you can read these straight away. We then want to jump into the valuation, where we get our intrinsic price of $225, which is ultimately the average of these three models. We can show you the makeup of these, the inputs, the outputs. First one, multiples valuation, companies in a similar sector and size. Their average P, the EPS of STZ, which gives us an intrinsic price of 222, thereby seeing undervaluation, although bear in mind we're not looking at any of these in pure isolation. We then have the dividend discount, the dividend fact over the last few years. Average growth just over 10%. We've gone a lot more conservative at 6.25. We do then get our second undervaluation signal. And finally, the DCF model, free cash flow year on year, average growth at 20%, a lot more conservative around management targets at 10%. With the discount rate, the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we see, 208, which ultimately comes to our 225 being the average of these three. Remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Constellation Brands or any others. And we're not just done there, as we do execute on companies with a 10% margin of safety if they meet our three golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that applies to this company, well, a buy up to $203, then we keep going till it's near the current trading price. And actually what we get to see in today's episode, even after the 8% run-up on the disclosure of Warren Buffett adding this to the Berkshire Hathaway portfolio, you aren't getting a 25% MOS just yet, but sitting somewhere between 20 to 25%, which could make it a consideration in your overall portfolio. As we said, Wall Street very bullish. They see this at $244 in 12 months time, and that equates to upside of 39%. In fact, this was nearly 50% before the jump from Warren Buffett's disclosure. As always though, give us your thoughts. 20 to 25% MOS, you are getting a fairly attractive starting yield, potential nice upside if you do want to take into Wall Street's considerations, but let us know below whether you think this is a buy, hold or sell. Don't forget to sign up to the free weekly newsletter. We are dropping a fresh copy tomorrow morning to your inbox. Grab those spreadsheets, come and join us in the Patreon as well, where we do cover our weekly buys and sells, which we have been making movements in the portfolio given the volatility over the last few weeks. As always though, have a great day and we'll see you all on the next one.